Good morning, good afternoon, good evening, depending on where you are watching us from and when you see this video. My name is Engineer Chidi Ezekiel, popularly known as Shaxi FS. Today we are doing introduction to forex trading. This course is inspired by the experience I had as a beginner trader. When I started trading, I was lucky, as they used to say, that the beginner's luck always hits all the beginners. I made money. I actually doubled my $540 account to $1,200. Then all of a sudden I lost the money. So I lost the money on a Friday, and I asked my friend what happened. I don't understand what just happened to the market. He said that it was news. I said, news? What was news? He said, you don't know what is news, and you say you're a forex trader. So it now dawned to me that it's not just all about the charts, the indicators. There's so many other things that are involved. So I now quit and I got myself a mentor who now started showing me what it means to be a trader. So I prepared this course for the newbies, intermediates, or even a struggling forex trader who have been here for a long time but doesn't know why the chart moves. So pay attention, follow me as I'm going to drop more contents so that you will not be a victim of rise and fall in forex, because it's very painful. The experience is not what you wish even your enemy. So let's dive into what we have today. Introduction to forex trading. Forex, or foreign exchange, is the global marketplace for buying and selling currencies. It operates 24 hours a day, 5 days a week, and involves trading pairs of currencies. So when they are saying 5 days a week, it's Monday to Friday. So Monday to Friday is still normal activity going on. So what they are saying is going on for 5 days means that was the day you and I is active in the market, buying and selling our goods and services, clearing, exporting, importing goods. These are the factors that attributes to forex trading. So without all these activities, there is nothing like exchange. So I've been assessing locally what forex trading is all about. So it's not just all about going to the chart and start trying to see where the candle is going and where the candle is not going. These are the basic things you have to know. So with this understanding, you can approach markets, that's charts, like a business. You can now approach it like a market. So you now begin to understand what is and what is not. So that you will not be like, I don't understand what's going on here, my strategy is no longer working. There's no strategy that is not working. It's just that you didn't understand what the market is saying at that particular time. For example, markets will always buy and markets will always sell. It all depends on who are in the market at that particular time. Is it the buyers or is it the sellers? So let's go on with the introduction we are doing. So for example, if you believe the value of euro will rise against US dollar, you might buy euro USD pair. So that's if you believe that euro will start going up, you buy euro against USD, so that once the euro have finished going up, you can change back your money to US or to your local currency. So that's how this trade are being done. So currency value fluctuates based on various factors like economic indicators. Economic indicators is nothing but the news. Like in Nigeria, our president said we are removing fuel subsidy, and what happened? The price of fuel did what? Skyrocketed immediately. That's news events. They usually give news from Washington, and they will say so thing is about to occur, or B will say, okay, that's the president of US. You might say, okay, we are going to war with Russia, what happens? Market will start shaking, because people will start clearing their goods. People who have not bought will start buying to make sure that they are not trapped at the center. So all these activities will start generating flow of currency. So once there is a flow of exchange, market dynamics will start changing immediately. So that's what news used to do. So we are looking at also geopolitical events like earthquake happen in a particular place. That means their currency will no longer have flow, because people will stop going that side. So what happens? The value of the currency will start reducing. So you start trading them against another, because you know they are going to reduce. So with that, you start making profits. Something like war events like Russia-Ukraine war, Israel with Pakistan war, that Gaza war, then all these things attributes to the value of currency. So these are what we are looking at in a bigger form for you to make decision on your chart, and you'll be right. And market sentiment, like for example, Elon Musk will say, okay, we are about to buy so crypto, we are about to launch so thing. Then what happens? There will be market dynamics, because people will really believe that because he's a billionaire, he knows what he's saying. He believes that so currency will rise or so currency will fall. That is why he's going for so currency. So because of that sentiment, people will attempt to buy with him. Influencers like Elon Musk and other influencers, big traders, they will say, okay, we are looking at gold about to fall. Gold will fall so price. What happens? People will follow him to sell at that particular price. That's market sentiment. So with market sentiment, there can be dynamic fluctuation, but it cannot last like economic indicators and geopolitical indicator. So it's always a short period of sell or short period of buy when we are talking about market sentiment. So let's go on. Forex, short for foreign exchange, is a decentralized global marketplace where participants trade currencies. It is the largest financial market in the world, facilitating the exchange of currencies between various participants, including central banks, financial institutions, corporations, and individual traders. The primary purpose of forex is to facilitate international trades and investment by allowing entities to convert one currency into another. Basics of forex trading. Currency pair. In forex trading, currencies are quoted in pairs such as Euro USD, USD JPY. Why they are quoted in pairs? Because there's nobody that is island. So you cannot say you are isolating yourself to the world. That means it's either you are buying or you are selling. So there's nobody that will say he's not buying or he's not selling. So that's why it is being paired, because you must either be exchanging to this one to buy from that country, or to this one to buy from the other country. So that's what currency pairing is all about. So the first currency in the pair is the base currency, and the second is the quote currency. The exchange rate tells you how much of the quote currency you need to spend to purchase 1 unit of the base currency. So market participants. So we are looking at central banks. They play a crucial role in the forex market by influencing interest rates and implementing monetary policies. Financial institutions, large banks, hedge funds, and other financial institutions engage in forex trading to facilitate transactions and hedge against currency risks. Companies involved in international trades may use forex to manage currency exposure. Retail traders, individuals participants through online platforms aiming to profit from currency value fluctuations. How forex works: supply and demand. Like any market, forex prices are influenced by supply and demand dynamics. If more people want a particular currency, its value will rise. So this particular sentence here has an app that should show you how many people are willing to buy, how many people are willing to sell. So with that, now you can take advantage of it, knowing that if the people who are willing to sell are many, then what happens? The market will start buying. Then if people who are willing to buy are many, the market will start selling. So with this understanding alone, you can start making profits in forex. So let's go on. Market participants and liquidity. The forex market is highly liquid due to its vast number of participants. The liquidity ensures that traders can enter and exit positions with ease. So currency value and determinants. What constitutes the value of a currency? So with this, now you can understand why your currency is in so price and why the other currency is in so price. So with this, now with this understanding, you'll be able to understand what you are looking at the charts when to enter the market. So you'll not just be looking at the charts because chart is going down or chart is going up. We'll now be targeting it, having a foresight, that's the bias of what markets is about to do. So we are looking at economic indicators, factors such as GDP growth, employment rates, inflation influence a country economic health, affecting its currency value. So these things are what affecting currency values. Interest rates. Central banks set interest rates and currencies from countries with higher rates often attract more investors. So if your country have higher rates, often it will attract more investors. So let's continue. If you didn't get it clear, for example, if your central bank set a high interest rate, what will happen? People will tend to borrow money to the bank. That's, people will lend money to your Federal Reserve, to your federal government. So that interest now will start coming in for them, and they start making money because of the money they lend to your federal government. So that's our investors. So we'll talk about that in another video. So political stability and economic performance. Countries with stable political environment and strong economic performance typically have stronger currencies. Like they say, US dollar is more stable than other currencies because of their economic performance and their political step. So trading sessions. Forex operates 24 hours a day, 5 days a week across major financial centers globally. The market is divided into sessions including Asia session, Europe session, and North America, each with different characteristics. Mechanics of forex trading. Brokerage accounts. Retail traders access forex market through brokers who provide online trading platforms. These platforms offers tools for analysis, charting, and other execution. Currency symbols and quotes. Currencies are denoted by 3-letter symbols. The exchange rate represents the value of one currency in terms of another. For example, if the Euro USD pair is quoted at 1.2, it means 1 Euro USD is equivalent to 1.2 USD dollar. Long and short term positions. Traders can take a long position anticipating a currency value will rise, or a short position anticipating a decline. Profits and losses are determined by the price movement of the choosing currency pair. So when you say you are going for a long, you're actually trying to say you want to buy. And when you say you are going for a short position, it actually means you want to sell. Leverage. Leverage allows traders to control larger positions with a small amount of capital. While it magnifies potential profits, it also increases the risk of substantial losses. Leverage is an opportunity that brokers used to give you so that you can trade with $10. They will do it such a way that the system will be seeing you as that you came with $1,000, or you came with 1,000, or you put your 1,000 naira. Then the system will be seeing you like you have 100,000. So that's leverage. But as they make your money look big, so your money can also vanish at the same time. So you have to, as you're making use of the advantage, you're taking advantage of leverage, bear it in mind that you are also exposing your capital more. Forex analysis and strategies. Technical analysis. Traders use historical price charts, patterns, and technical indicators to forecast future price movements. Thus, you are using tools that you see on your broker or on the site to analyze the history of charts, that's trying to understand the behavior of the market in the past, the pattern at which it was doing, so that you can now be able to forecast what actually it might do in the future. Fundamental analysis. This involves examining economic indicators, interest rates, geopolitical events, and other factors to assess currency's intricate value. That's like, now you cannot know by the policies the government generates, the news what they are saying that they want to do, or what they are doing already, maybe war going on in a particular area or in a particular country. It will also determine the fate of their currency, because it's human activity that determines the value of a currency. So if you see that the activity is going against their economy, it means that their currency will fall. So you have to position yourself using technical analysis to know exactly when and how to enter the market. So let's go on. Risk management. Successful forex traders involve managing risk. Traders use stop loss orders and position sizes to protect their capital. So risk management is one of the major, as is like 80% ability that a trader have to have for him to be successful in trading. So the major thing is to protect your capital. So you always use stop loss in every trade you put, so that you can be able to safeguard your capital in case the market did not go in the direction you predicted that it is going to go. That means, it simply means you did not say what market is showing you, you did different thing. So when you are wrong, it's normal to be wrong sometimes, because you may not know everything. But even if you are wrong, stop loss will help you to safeguard you for another day, so that when you are right, you can make profit. Risk and challenges. Volatility. For volatility, forex markets can be highly volatile, leading to rage and unpredictable price movements. Forex markets can be highly volatile and leading to rage and unpredictable price movement. Actually trying to say that prices can actually fluctuate so fast that it will take out people in the market, so it will move to a stop loss so fast. But actually it's because of when your analysis is not analyzed well, then the market will take you out in the market. It's not actually that is looking for a stop loss. It just simply means that you do not analyze well, because if you do analyze well, you see where the market will actually come before it start going. So you will not put a stop loss after it's finished coming, because normally market must come to take all the order in the market. So once it takes all the order in the market, it will start moving in the right direction. So but if you don't know that market will take out all the order, then it will take you out as well, because even stop loss is part of the order in the market. So let's go on. Leverage risks. While leverage amplifies potential profits, it also increases the risk of significant losses. Traders must use leverage cautiously. Market sentiment. Public perceptions and sentiments can influence currency values, and sudden market reaction may occur based on news and events. Conclusion. In summary, forex is a dynamic and complex market where participants trade currency based on various factors. It plays a pivotal role in the global economy, providing a platform for international commerce and investment. Whether you are a central bank, financial institution, corporation, or an individual trader, understanding the intricacies of forex is essential for navigating this vast and influential financial landscape. Successful traders requires a combination of knowledge, analysis, and risk management, and the ability to adapt to the ever-changing condition of the market. So you have to understand so many things for you to be a trader, not just analyze. You have to know your risk management very well, and you have to combine the knowledge of your analysis and the news you are hearing. So that's why it's a complex thing. Just like you can't just say you are a doctor because you know how to cure headache. You have to know many things to make you a doctor. So is forex. So you have to know many things for you to say you are a forex trader. Let's go. We are looking at the history and evolution of forex market. Let's look at what happened in the past in the forex sector. History and evolution of forex market. The history and evolution of forex market span several centuries, reflecting changes in global economic structure, monetary systems, and technology advancements. Here is a concise overview. Pre-1970s, the gold standards and fixed exchange rates. Before the 20th century, the gold standard prevailed, where currencies were directly linked to a specific quantity of gold. This provided stability but limited flexibility. In the interwar period, the gold standard collapsed, leading to economic instability. Bretton Woods Agreement, 1944. After World War II end, major nations established the Bretton Woods Agreement. creating a system of fixed exchange rates pegged to the US dollar, which was convertible to gold. This agreement aimed to stabilize global currencies and promote economic reconstruction. End of Bretton Woods system in 1971. In 1971, US President Richard Nixon abandoned the gold standard, serving the link between the dollar and gold. This marked the shift to a floating exchange rate system, where currency value were determined by market force. That's what led to forex now that we are doing on system. Emergence of forex trading, 1970s. With the currency no longer tied to a fixed value, the forex market as we know it today began to take shape. Currency trading became more accessible, initially dominated by banks, financial institutions, and multinational corporations. Advent of electronic trading in 1970. We started using electronics to trade. In 1980s saw the introduction of electronic trading platform, allowing banks and financial institutions to execute trades electronically. This technological leap increased efficiency and accessibility. Internet era and retail trading in 1990s. The rise of internet in the 1990s democratized forex trading. Internet era and retail trading in 1990s. The rise of internet in 1990s democratized forex trading. Retail traders gained access to online platforms, enabling them to participate in the market. This era also witnessed the development of charting tools and educational resources for individual traders. Globalization and 24 hours market, 2000s. The forex market became truly global, with trading occurring 24 hours a day across different time zones. Increased internationally, trade and financial globalization contributed to the market's growth. Financial crisis and impact in 2008. The 2008 financial crisis led to increased market volatility and surged in forex trading activities as investors sought opportunities in currency markets. Central banks played a crucial role in stabilizing economic through monetary policy. Algorithm trading and high frequency trade, 2010. Advancements in technology lead to the rise of algorithmic trading and high frequency trading strategies. Computing algorithm could execute trades at speed beyond human capacity, influencing market dynamics. Regulatory changes. Regulatory bodies worldwide implemented measures to enhance transparency and protect retail traders. Stickers regulations aim to prevent malpractice and ensure a fair and secure trading environment. Cryptocurrencies and blockchain technology in 2010 to 2020. The emergence of cryptocurrencies such as Bitcoin introduced a new dimension to the financial market. Why not part of the traditional forex market? The impact of digital assets on global financial has been significant. currency trends in 2020s. The forex market continues to evolve with advancements in artificial intelligence, machine learning, and big data analytics. These technologies are influencing trading strategies, risk management, and decision making processes. The history of the forex market reflects a dynamic interplay of economic, political, and technological factors. From the gold standard to the present era of electronic trading, global connectivity, the forex market remains a vital component of the world economy, offering opportunities for a diverse range of participants. Market participants and their role. The first market is a decentralized global marketplace where a variety of participants engage in currency trading. Each participant plays a significant role contributing to the overall dynamics of the market. Here are the key market participants and their roles. Central banks. Role: commercial banks facilitate currency trading for their clients, including corporations, governments, and retail traders. They act as market makers, quoting bid and asking price, providing liquidity to the market. Banks also engage in proprietary trading for profit. Commercial banks. Role: commercial banks facilitate currency trading for their clients, including corporations, governments, retail traders. They act as a market makers, quoting bids and asking price, providing liquidity to the market. Banks also engage in proprietary trading for profits. Financial institution. Beside commercial banks, various financial institutions such as investment banks, hedge funds, and pension funds participate in forex trading. They trade currency to manage portfolios, hedge risks, and seek profit opportunities. Hedge funds in particular may employ diverse trading strategies. Corporations. Role: companies engage in international trades use the forex market to exchange currencies when conducting business across borders. Corporations. Role: companies engage in international trade use the forex market to exchange currencies and when conducting business across borders. Corporations also utilizes forex to hedge against currency risks, protecting themselves from advanced exchange rate movements. Retail traders. Individual traders, often referred to as retail traders, participate in forex through online platforms provided by brokers. They speculate on currency price movements, aiming to profit from fluctuations. Retail traders contribute to market liquidity, although their individual trades are relatively small compared to institutional participants. Government. National governments engage in forex markets to influence their currency value. This may involve direct intervention such as buying or selling currencies to stabilize or manipulate exchange rates. Governments may also participate to address economic imbalance. multinational corporations. Rule: large companies with corporations in multiple countries are exposed to currency risk. Multinational corporations use forex to manage their forex exchange exposure, ensuring that fluctuations in exchange rate do not negatively impact their financial performance. Broker. Rule: forex broker acts intermediary. Brokers. Rule: forex brokers act as intermediaries, facilitating trades between buyers and sellers. They provide trading platforms, access to the market, and leverage. Brokers may operate as market makers, taking the other side of their clients' trades, or as ECN STP brokers, connecting clients directly to the interbank markets. Market makers entries often bank or brokers that quote both buy and sell price for a currency pair. They provide liquidity by being willing to take the opposite side of the trade. Market makers earn from the spread, the difference between the buying and selling price. Speculators, including individual traders and hedge funds, engage in forex with the primary goal of profiting from currency price movement. They contribute to market liquidity and can influence short-term price fluctuations. Understanding of the role of these diverse participants is crucial for comprehending the complexity of the forex market. The interactions of these entities create a dynamic environment where supply and demand forces determine currency prices. Major currency pairs and their characteristics. The forex market involves trading currency pairs, where one currency is exchanged for another. Major currency pairs are the most widely traded pairs, including currency from the world's largest economies. Each pair has unique characteristics influenced by economic factors, geopolitical events, and market sentiment. Here are some major currency pairs and their characteristics. Euro USD, the Euro US dollar. Characteristics: most traded currency pair globally. Influenced by Eurozone economic indicators and US economic data. Sensitive to interest rates, differentially between the Eurozone and United States. USD JPY, Japanese yen. Characteristics: reflects economic condition in the US and Japan, often influenced by global risk sentiment, as the Japanese yen is considered a safe haven currency. Affected by Banks of Japan policies and US economic indicators. British pounds and US dollar. Characteristics: influenced by economic data from the United Kingdom and the US. Sensitive to brief developments and political events in the US. general exhibits high volatility. US dollar and Swiss francs. Characteristics: connects the US dollar and Swiss francs. Swiss francs is often considered a safe haven currency, affecting pair dynamics. Australian dollar and US dollar. Ties to Australian dollar to the US dollar. It's influenced by commodity price, as Australia is a major commodity exporter. US dollar and Canadian dollar. Links the US dollar and the Canadian dollar. Movements are influenced by factors like oil price, as Canadian is a significant oil exporter. These pairs are widely used by traders and investors for their liquidity and wealth of information available about them. When trading this pair, it's essential to consider economic indicators, geopolitical events, and central bank policies that can impact exchange rates. So we have come to the end of introduction. Hope you learned something. Please find it worthy to like and subscribe to this channel. Thank you.